Welcome back, everybody. I hope you enjoyed your break, and we're going to go ahead and continue on to part two of session one. We left off looking at depreciation, so that's going to be the next topic that we jump into. So let's go ahead and get into that. Depreciation expense. So I'm sure you hear this term a lot, no matter what you do. If you've ever watched the movie The Accountant, if you hear some of the terms as he's, going through the books, he throws out the word depreciation and amortization several times. And then as an accountant, I end up picking that up because if you follow that movie, the depreciation wasn't part of the fraud, but they just like to throw out those terms. But what is depreciation? Well, when you purchase a fixed asset and you capitalize, again, back to that cap policy that we just talked about. So we have $1,000 laptop that we just capitalized and we're putting it onto our balance sheet. That asset will lose value or depreciate over time. And so what you need to do is you need to take some of that cost, let's say that $1,000 laptop, and you need to allocate it over a period of time, because eventually that laptop will be worthless or have very little value. Just for your general knowledge, most computers are depreciated over 3-year lives. That's just kind of what everybody does, because usually about after 3 years you toss that laptop and you go buy another one. But depreciation is we take that cost and we allocate it over the life of the asset, and we take that proportionally to the income statement. So remember how we talked about threshold, the capitalization threshold, let's say in our example was $250 and we capitalized that $1,000 asset. Well, the way that expense ends up getting to your income statement is through depreciation expense. And depreciation expense, the thing that people don't realize is it's the hidden cost. So when you have a whole bunch of fixed assets and you're depreciating them, that's more or less taking that cost of that asset, so taking it to your income statement. But if you think about it kind of reverse way, that's part of an asset that you're going to have to replace at some point in time. So like the laptop, if it's $1,000 and you're depreciating it over 3 years, well, at the end of the third year, theoretically that laptop's going to have zero value, and you're going to have to replace that laptop. And let's just say you buy another $1,000 laptop. Well, under a kind of an unusual way, some people actually think about depreciation this way, is they think that this depreciation expense I'm taking my income statement, that's something I need to consider of setting aside, because eventually when that asset goes kaput and I need to get a new one, I already got the funds set aside. Now, in my 20 years, I've only seen like 1 or 2 companies ever actually do that, but that's just something to consider, is depreciation really is a hidden cost. It's a replacement cost that you're going to eventually have to make up at some point in time. So let's walk through a quick example. So the simplest way to calculate depreciation is take its estimated life of the asset and divide it into that cost. Now, most vehicles, most equipment are going to be 5-year assets. And so when you take the life of the asset into the cost, that is what's called straight line depreciation. Now, there's a whole bunch of methods out there, and I'm not going to get into all of them, but I'd say about 90% of the US uses straight line depreciation, which is a totally acceptable depreciation method. And so in this example that we have here, we've got an asset, let's say we said it was a $15,000 asset and had a 5-year life. So what that means is we're going to take $3,000 cost every year for 5 years, and that cost, the depreciation expense, is going to go to the income statement. And then the opposite side of your entry, so remember back to our scale that we talked about, so we know depreciation expense and expenses in general are going to be debit balances. So if we know we have to take a $3,000 debit balance to the income statement, well, we need to take a $3,000 credit somewhere. And in this case, we take it to an account called accumulated depreciation. And what accumulated depreciation is really a contra account to your fixed assets. So whatever your accounting software is, let's say you have QuickBooks, when you post your depreciation expense, your accumulated depreciation accumulated depreciation is going to show up right underneath your fixed assets, and then there'll probably be a line that says net fixed assets. And so that is what a contra account means, is it goes in the asset area, and it's a contra to, in this case, an asset account. So just want to kind of walk through that example real quick. And again, keep in mind, depreciation expense is the hidden cost, replacement cost. Now, let's get into the other bugaboo, tax depreciation. So, excuse me, most tax accountants will use a different method for depreciation than what you use for your books. And that's why you'll sometimes hear the term book depreciation and tax depreciation. Book depreciation is what you will use on your books. Tax depreciation is what your tax accountant uses. What's the difference? Well, the predominant method that most tax accountants use, which is allowed under the IRS rules, is called MAKERS, and that's a modified accelerated cost recovery system. It's a big old fancy word. In other words, they depreciate it faster than what you do for your book purposes. And so that was one of the big differences there. Just be aware that many times the depreciation expense your tax accountant calculates is going to be way different than what you calculate. And again, this is common. So let's take a look at a quick example so you can just get a kind of a look at some numbers and get an idea as to what we're talking about. So here is an example of depreciation, and again, this is just a very simplistic one. And really what I wanted to show you is what a book basis and tax basis would look like. So in this example, we have a skid loader, $25,000, has a life of 5 years. We're going to make life easy. We're going to say it was placed in service on January 1st. And of course, with straight line, that means we have yearly depreciation of $5,000 a year for book basis. So here's kind of what you would see in a depreciation schedule. Beginning accumulated would be 0 in year 1. Here's our $5,000 expense, ending accumulated $5,000. Next year, another $5,000 expense. Our accumulated goes to 10. Again, year 3, $5,000. Accumulated goes to 15, so on and so forth. So we get to end of year 5, 25,000 accumulated. Again, it equals our cost, so our net book value will end up being 0 after 5 years. Now, tax basis, as you can see, first year in this example is 5,000. It's equal to the book basis. But then look at here. The very next year, it gets even bigger, and then it reverts back down to a lower amount. This is because of how they accelerate some of the depreciation. And this is really what you want on your tax side. You want to accelerate as much depreciation as you can on an asset as you're going through your business. It's just important that you understand that there's always going to be a difference between your book basis, as you see here, and your tax basis. And so that's perfectly acceptable, and it's okay. So I just want to make sure you understand that, so that when you get your tax return back from your tax accountant, and he has got a depreciation schedule in there, and you look at that and you compare it to your book basis, and you're like, whoa, these don't match. Well, that's why. And just for your information, don't put your books on the tax basis, the depreciation on your tax basis. The reason being is what can happen is you're going to use this accelerated method, and first off, just so you understand, general accepted accounting principles, GAAP. Well, the funny thing about GAAP is it indicates that tax basis appreciation is not acceptable under GAAP rules. So let's walk through this. Let's say you have to submit your financials to a bank. Well, if you got your fixed assets on a tax basis, the bank may come back and say, well, you need to put your books on a GAAP basis, and this is not GAAP basis. So then you have to go back and fix your books to that. The other aspect to the reason why you don't want to put your depreciation on a tax basis for internal book purposes is it'll skew your analysis. So especially if you're a manufacturing company, you need to understand when that asset, when that machinery, when that press, whatever it is, when it's going to truly depreciate out. And because you're going to take some of that cost to your cost of goods sold, which then eventually translates to the inventory. But if you're on a tax basis, it's going to skew that all over the place. As you can see, that first year or second year, you're going to be taking a lot more depreciation than you normally would. So that's what I always tell people. don't put it on a tax basis. I've only seen one industry where it really actually made sense, and that was the oil and gas industry. When you have all those guys out there in those trucks and they're beating those trucks up because they've got to drive to remote locations and tow, huge equipment, and they're very, very rough on the vehicles. So an accelerated depreciation on those makes complete sense. But for the most part, that's about the only time I've ever seen that be a reasonable aspect there. Now let's quickly talk about business expense versus personal expenses. Now, this is one of the areas where the lines can get blurred. And a helpful reminder, something to think about. Now, this isn't always going to be exactly true, but it's going to be kind of a rule that you can use as you go through your business is, was the service or product received by the company, or was it received by the owner of the company? And another thing to think about is, was the product or service for the benefit of the company, or was it for the benefit of the owner? Obviously, if it was for the benefit or was received by the company, it's probably going to be a business expense. If it was for the benefit of the owner, it's probably going to be a personal expense. So let's say you've got a manufacturing company, and all of a sudden an 82-inch flat screen TV shows up, and that flat screen TV actually then goes to the owner's house. Well, clearly that's a personal expense. That's not a business expense. So that's kind of how you want to think about it, is how does it pass the smell test? And who is the person that's doing the smelling? It's going to be the IRS. So make sure you kind of have an idea, and especially for all your expenses, because if you ever get under audit by the IRS, even though they may go back and refute and disallow an expense, as long as you have a reasonable basis as to why you have an expense as business versus personal, they're not going to be that concerned. They may disallow it, but at least have a basis for why you're saying, hey, this is personal, this is business. So again, we've gone through a lot of stuff, and we've got a couple more slides to go, but I just want you to understand that, again, we're building the foundation. We're building this for the accounting records, and you can't analyze your records if they're not accurate. And so we got to make sure we understand all these items right now, because we're going to build on top of these and on top of these. So just want to make sure you understand. If you need to, go ahead and take a break. But we got a couple more concepts to go through, and once we get through this, then we'll start getting into the more entertaining stuff as we go through the core financial statements. General journal entries. Now, this is one of those things that it's important to understand that general journal entries are posted when it doesn't fit into a sales area or expense area. And what I mean by that is, as you can see in these bullet points, if you purchased an investment or you purchased a fixed asset, well, that's not a normal expense. That's not, making a payment to the vendor because they delivered, a roll of steel, or they, delivered some tar or rubber or what have you. It's just something out of the ordinary of the standard cash disbursement cycle or cash receipt cycle. And so you would post a general journal entry for purchasing an asset, purchase a fixed asset, or in this case, if you sold a fixed asset. That's almost always see a journal entry if you sell a fixed asset. So you got rid of it, you got to sell it. You got to put in a general journal entry because it doesn't fit any of the normal income or expense areas. Again, dividends, and then of course reclassification of income statement items. That is, so a lot of times what will happen, particularly with overhead. So when you're going through and you calculate what the overhead should be allocated to the cost of goods sold, you'll do a general journal entry to move items from the various expense accounts up into the overhead. And that's just what's commonly called a reclassification entry or reclassification adjustment. Again, that falls under the general journal entry kind of rules. Now, adjusting journal entries. So remember, we just talked about general journal entries. Now we're going to go through adjusting journal entries. And adjusting journal entries are journal entries you post to fix an account balance. Now, think about that. We're posting something to fix it, not to record the transaction. we've already had a transaction recorded there, but we notice the account balance isn't right. So we need to fix that account balance. So the best way to think about it is, let's say we had a balance that should be $100, but the balance showing up on the general ledger is $60. So in this instance, we know we have to do an adjustment. And in this case, it's going to be a $40 adjustment to fix the account. Now, adjusting journal entries are usually posted for estimates. So you have several accounts on your balance sheet that are estimates, your bad debt allowance. Now, when you set up an allowance for bad debt, that's saying, okay, of all my accounts receivable, historically, I don't collect 3% or 5%. So you're going to estimate that allowance. Your accrued payroll, sometimes that's an estimate, because payroll may straddle the end of the year, and so you're estimating, okay, of the 14 days, 8 days are in this fiscal year, so I need to accrue 8 days. So maybe tax, you estimated a tax payable, but you're just estimating it, you're not doing the actual tax return. So let's take a look at what the formula is. So the formula for calculating an adjusted journal entry is what the account is, what the account should be, and then that gets your AJE. Or as they say, is what it is, what it should be, here's your AJE. So let's take a quick example, take a quick look at a quick example, and I'll kind of walk you through this. So let's take a look at an example on adjusting journal entry. Now, in this example, we take a company and we say that the company estimates their allowance for bad debt. Again, that's a contra to your accounts receivable. Should always be 15% of accounts receivable. Now, that's very aggressive. Normally, you wouldn't be that high, but for this instance, we'll use that. So, in this instance, they say their gross accounts receivable at the end of the month is $13,400. Their current balance in their allowance account at the end of the month is $1,375. So based on this information, we're going to calculate what the allowance should be. So current balance, $1,375. We know the AR balance now is $13,400, and their allowance should be 15% of that, or $2,010. So we have our what it is, $1,375, what it should be, $2,010, and what's our adjustment, or our AJE, that we need to post, and in this case $635. And so we end up posting an adjusting journal entry of bad debt expense of $635 and allowance for bad debt expense, or allowance for accounts receivable, of $635. Again, here's our debit credit, our entries balance, and it's only going to be off of an estimate, so it's really an adjustment. So we know our account is $1,375, we know it should be $2,010, so that's when we post an adjusting journal entry. So now, chart of accounts. Now, a chart of accounts is very important, and some people don't realize it. When you first start out, it may not seem really that big of a deal, but as your company grows, you need to have a chart of accounts. So it's good to get into the habit of having a chart of accounts right away. If it's common for software such as QuickBooks, make your life easier and put account balance numbers in there. Now, QuickBooks in particular, they'll let you go ahead and post adjustments to cash, accounts receivable, so on and so forth, and not have any actual chart of accounts, i.e. account numbers, in there. But again, you want to have it in there. So let's take a real quick look at an example of what a chart. So here is just a very generic chart of accounts. Again, I just took a very simplistic account balance or account descriptions and put in account numbers. Now, as you can see in here, all the asset accounts begin with a 1. All the liability accounts begin with a 2. Equity accounts 3. Revenue 4. Expenses 5. And then miscellaneous 6. That's kind of the traditional way that most chart of accounts run. Most of your asset accounts will be in the 1,000 or 10,000 series, depending on how many account numbers you want to put in there. Most of your accounts payable are going to be in the 2,000 area. and so on and so forth. And so that's why when you set up your chart of accounts, you want to not just jump into your accounting software and just start entering numbers. Map out how you want it to be. Reason being is, as you grow your business, let's say you're just a small one person shop. Well, let's say down the road you expand. So let's say you're in Texas and you're headquartered in Houston, but then you want to put in another office in Dallas. Well, if you have a chart of accounts, what you can do is, after each of the chart of account numbers, is you can put a dash and have another number within the chart to signify location. So in this case, let's say this cash account, it's 1,000, and let's say for Houston it'll be 01, and for Dallas will be 02. So all accounts that have 01 will be Houston, Dallas will be 02. So what you'll see in this instance is, instead of 1,000, it'll be 1,000-01. That'll signify cash account Houston. 1,000-02 cash account Dallas. So that's the beauty of a chart of accounts, is you can start doing that. And if you get to the point that you start having various departments, you can add another dash. Now, don't get too crazy on your account structure, but you want to make it so your account structure that you can quickly identify it's an asset account, and if you have different locations, you can quickly identify what location it goes to, and if there's departments, you can quickly identify what department. And as you start getting used to it, you'll start seeing just the account numbers, and you'll know exactly where it goes. The other nice thing about having a chart of accounts is it makes your journal entries so much easier. Again, when you first start out, you don't have that many accounts to begin with, so knowing what account description to use when you're posting journal entry is usually pretty quick and easy. But as you start growing, it makes life so much easier to have an account number for when you're doing a journal entry versus trying to remember the account name, because you may have a whole bunch of different names that sound the same, and you may not, you may get confused on those. So again, that's really what you want to do. Now here's another example, and this is what's called a trial balance. So you will hear the terminology through a bunch of accounts is, hey, can you send me your trial balance? Usually, like your tax accountant will say when he's doing your tax return, can you send me your trial balance? And what a trial balance is literally it lists out all the accounts, what the balance is as of a point in time, and it'll probably list out the account numbers. Now in this example, you'll see here I put account numbers, here's the descriptions, and here's the account balances for each of these respective accounts. Now I didn't use all the ones from the previous example, but I just want to give you an idea as to what a trial balance looks like and how it corresponds also with your chart of accounts. Now an important thing here to notice is, see how this adds up to 0? Your trial balance should always equal 0. And so that's very important to understand. Again, this means all the debits and all the credits equal one another. You also see in here the credits are showing up in brackets or negatives. And that's traditionally what you see in a trial balance and in most higher end accounting software. Now, the software that you're probably using, whether you're using QuickBooks or Xero or FreshBooks, a lot of times those softwares don't show credit balances as negatives. They just show it as a balance. And so when you're looking at a set of financials, and again, we'll go over this when we start going through the actual financials themselves in the next session, but when you're looking at a set of financials and you're looking at accounts payable and it doesn't have brackets or a negative sign in front of it, you need to ask yourself, okay, does this mean that this is a debit balance, or are these credit balances and the software is just making it look like debit balances? And so that's just something to keep in mind, is traditionally what you see is credit balances will have negative or brackets around them, and that's because you want to be able to add all these accounts up when you have your trial balance and you want it to foot to 0. And again, as you see here, here's our chart of accounts as well tied to that. Now, closing out books. Now, this is a term that gets used a lot in the accounting world. And by accounting world, I mean by anybody who does accounting. And a lot of times it gets used inappropriately. And by inappropriately, what I mean is I've heard and I've came across this several times is you'll have a bookkeeper or accountant say they need to close their books out for June or they need to close their books out for July. Well, that's really an inappropriate use of the term, because when you close out a book or you close out your books, what you're doing is effectively taking all the income and expenses and sending it over to your equity, and you're resetting your income to zero and you're resetting all your expense accounts to zero, i.e. for the next year. And that's truly what closing out your books means. And so some people will use that term inappropriately for that month's transactions. Well, they're not really closing out their books monthly. They're just tying out their balance sheet to make sure everything's in place, but they're not truly closing it out. So again, in a nutshell, closing out your books is taking your net income or loss to your equity accounts. So you really only do it once a year. You don't do it monthly. Now, when you do it at the end of the year, do not close out your books until all the balance sheet accounts have been reconciled and all your material invoices have been reconciled. The reason being is if you close your books out too early, and some software, when you say close out the year and you can't go back and fix it, well, let's say you haven't tied out your accounts payable and you've got a whole bunch of invoices that still need to be entered for the the fiscal year you just closed out. Well, what that's going to do is that's going to mess up your equity accounts, which then will trickle to you're going to have expenses in the wrong year. Let's say they're 2019 expenses, but because you close your books out too fast, they show up in 2020 expenses. Well, that's going to mess up your analysis. That's going to mess up your break even. And again, that's going to mess up your equity. So that's why we want to make sure we don't close our books out too early. So let's take a quick look at an example on this. So here we have an example of what closing out your books looks like. Now this is just a very generic example, but I wanted to show you first what it looks like, how it flows through everything, and then how closing out your books too early can have a dramatic impact on your financials. So as you can see, here is just a generic balance sheet, total assets, total liabilities, and equity. These two match, and then here's your net income for the year. So in this particular situation, there are $75,000 in sales and total net income of $10,000. Now the way closing out your books works is you take your beginning balance of your equity, in this case $5,000, you add in your net income, so in other words you're closing out all your revenue and expense accounts. You're resetting those to zero, so you're closing out all the activity, and that closeout goes into your net income, which then goes into your equity. And so in this situation, we had $5,000 of beginning equity, $10,000 net income, and ending balance of $15,000 in equity. So as you can see, and there's a reason why I have these arrows here, that $15,000 then translates over to the equity balance over here on your balance sheet. And so this is how your balance sheet will balance out, is your net income gets closed out to here. And as you can see, net income, equity, equity over to your balance sheet. So now let's assume that we closed our books out too early. Let's say we incurred a $7,000 expense in December of 2019, let's say late December, but we didn't get the invoice in until the end of January of 2020. And let's also assume that we closed our books out January 5th. So $7,000, if you look at that, that's going to be a material amount to these financials. And if we close our books out too early, we're going to have our net income is going to be overstated and our equity is going to be overstated. And so let's see what that effect would be. So again, $7,000, we incurred it. So again, back to accrual accounting, we incurred that $7,000 regardless of when we got the invoice. We incurred that expense in 2019. So if we close our books out too early, we're saying our equity is $15,000. But if we come in here and we say, okay, we should have recorded that $7,000. So first, just in this example, I'll put the $7,000 up in liabilities because we owe the amount, we just haven't paid it yet. And as you can see, our balance sheet doesn't balance now. So now we need to put in the respective expense into the income statement in this example. So here's the other side, $7,000. And as you can see, obviously our net income went down to $3,000. But look what effect it had on your equity. Instead of being $15,000 in equity, the equity is now $8,000. And so our balance sheet, our total assets stayed the same, but our equity went down. And the reason being was there was an accrual that didn't come through and didn't get posted properly. And so that's what we want to make sure, that when you're closing out your books, you have everything as accurate as you possibly have, and you know that you've booked all the invoices that you know you've incurred in the last month of the fiscal year, and conversely, you've recorded all the revenue that you've earned in the respective December as well. So that's the important things. Now, there is a way to, let's say we go back and it's this invoice doesn't come in until after, let's say, February. We've already closed out our books, it's February, then all of a sudden that $7,000 comes in and we totally spaced it out. There is an accounting entry you can do to fix it without, quote, opening your books back up. And what that is it's called a prior period adjustment. Now, we're not going to get into the semantics of that. That's more of a higher level accounting entry. But in essence, what the entry would do is, because our books would be closed, we would hit our equity and we would hit the liability instead of hitting the income statement. Now, the other problem with closing your books out too early, you always technically have the option to, quote, run it through the current year. So if the $7,000, if we happen to be a multi-billion-dollar company and we get a $7,000 invoice, that's massively immaterial, so we'll just run it through the current year. But in this situation, let's say we just decide to run that $7,000 into the current year. Well, if you think about it, you're going to record a $7,000 expense in 2020. In this situation, we're saying they're 12/31/19 year end. So the very first thing you record in 2020 is a $7,000 expense. So that means you already have a net loss of $7,000 to begin the year. And if you're going to do your projections, you're going to do your break-evens, you're going to do your forecasting, how are you going to do that accurately if you have an expense that is last year's sitting in your current year information? So again, that's another drawback to pushing the invoices that come in into the current year. So that's why you want to make sure you have everything properly recorded. Alright, so that is the importance of closing out your books. So now, let's go to the bonus slide. And this is the pro tip that I want to give you so you understand that when you come across this certain situation, there is a quick and easy way to try to fix an error in your financials. Now, transposition adjustments. So what a transposition is when you flip a number, any two numbers, by accident, i.e. it's the common I fat fingered a number when I put it in. When you have a transposition error or transposition adjustment, you can usually detect it by dividing the difference by 9. It's fascinating how this works, but it truly does work. So let's say, a quick example, let's say you have a difference in account between what it is and what it should be. Okay, let's say it should have been $540, your invoice, but instead you accidentally entered $450. Common mistake, easy mistake to make, and so the difference between $540 and $450 is 90. So if I take that difference and I divide it by 9, or it will be divisible by 9. So anytime you have an error between what an account is and what it should be, if that difference is divisible by 9, there's a very good possibility you have a transposition error. And trust me, when you go in, you have that difference, you're trying to figure out why does this not match, this doesn't make sense, and you go and divide by 9, it's like, oh, I have a transposition error. So then you go back through and you start looking at the actual entries, and like I said, like in this example, you all of a sudden realize, oh, I entered 450, it should have been 540. And so you go and fix it, and then you feel so much better because you had the error fixed, and you didn't have to go through and just kill yourself trying to figure out why do I have an error in here. So this is a handy dandy tip, and again, always do this. Anytime you have a difference, obviously if you know right away the difference is 17, well, that's not going to be divisible by 9, but if you've got a large number, divide it by 9 real quick and say, hey, is it divisible by 9? And by divisible, it has to be an even amount. It has to come out to a whole number. And if that's the case, that can direct you to, okay, maybe I fat fingered something, and let me go back and look and see what that is. So, like I said, this is a handy dandy little tip. It's one of the things they teach you when your first year when you start doing public accounting, and in particular start doing auditing, is, hey, if you have a difference, divide it by 9 and see if that, it's a transposition error. So, again, run the test. I guarantee you it's divisible by 9. No matter how many times I've came across it, it's always going to be divisible by 9. So I'm sure there's some mathematical reason for it, but I'm not a mathematician, so I can't really opine on that. So that concludes session 1 on the concepts. On session 2, we're going to go through the core financial statements. And again, this is going to be one of those big things that we start seeing how transactions flow through within the financials, your balance sheet, your income statement, and your cash flow. And we're also going to go through a worksheet on the cash flow statement, so that not for you to calculate the cash flow per se, but so you have a basic understanding of how accounts affect the cash flow statement, and so that'll make more sense to you. So again, session 2 is coming up here in just a second, and again, like I said, if some of the items we covered in the concepts was a little too much for you, please pause the recording, rewind, and go back and re-review it. Again, these are very important things to know, because we're going to just start building on top of these. And with that, I thank you for your time.